Hello friends, welcome to our lecture series on financial analytics. This is going to be part 2 of our lectures on financial time series, in which we are going to have a discussion on composite index number and many other techniques or topics of financial analytics, or what you call as financial time series. So I'll first be telling you about the composite index number, wherein we are basically using a simple index using total price or total quantity of all the series of the data. And the only disadvantage what we face in composite index number is that we are not considering the quantity of each commodity purchased. So what we do, let me show you with an example what we do in composite index number. The closing stock prices of the last day of different months are provided for certain companies. There is a company called DM, Daimler Chrysler, Ford and General Motors. Between the year 2005 and 2006 the data is available with us, and what is required from us is we have to construct the simple composite index using January 2005 as the base period. So we have to take the month January 2005 as base, and we have to calculate the simple composite index with the help of the data available. So let us have a look at the data. This data is available for all three companies, and stepwise I'll be telling you what we do. We have to first make a total of these values, and then we'll be computing the index number. So step by step we'll learn how do we go ahead. Step 1 is that we have to compute the total for the three stocks for each date. So whatever date is available, we have to simply make an addition of the three values. Why three values? Because there are three companies for which this data is available. So the closing stock value of three companies are available with us, so we'll be making the sum total of it, and it is visible. If you look at the column number 5th, it is available. The total value is being shown here. And after that, what we do, the step 2 is that we'll compute the simple composite index by dividing each total. Say for instance, we are having the December 2006 value, so 12 by 6 price. So in December 2006, whatever is the price, it becomes our current value, and the first price which we have chosen as base, that is January 2005 price multiplied by 100, and the price which was given in the table is 99.64. My dear learners, just do remember it is a composite value, and this composite value of current year is divided by composite value of base year, and it is multiplied by 100, and it is giving me a value of 104.3. So this 104.3 is basically my simple composite index. So we have computed it. Just like this, we have to do the calculation for each year, for each value, for each data which is available in this series of data. So here what we are taking the composite value. So it is no different from the simple index number. In that, what we were doing, we were taking the data of one company, one value. Here what we are doing, we are aggregating those data which is available for different companies, and we are trying to compute the composite index. So calculating composite index is this easy, 104.3. and when you do the calculation for all the for every date, you find it here in the column number 6. It is visible that all the values, the first year value becomes 100 and the last year value becomes 104.3. So in this way you can do the calculation of simple composite index. You have to simply run the formula. You have to simply in Excel, if you go, you have to simply run the formula. You have to take the current year value, select that and divide it by the base year value and multiply it by 100, and you will find the value. You will find the simple composite index. So composite index is no different from the simple index. The only difference is we are making use of the composite data, and that is why we call it composite index. Simple composite index, if we plot it, again the plotting is done like this. The data is visible here. In case of simple composite index numbers from the year 2005 to 6, this is the trend month-wise. Whatever the date of the data is given, that we have shown on x-axis, and on y-axis we have taken the parameters. We have assumed the parameters, and we are showing the values here. So if you plot, you can find this kind of trend line, that initially it is a little stable for first two periods, then there is a downfall, then there is a correction, upward trend, then again slightly down, then up, and afterward almost stable, and then on the direction in the direction of upward trend, drawing upward trend, we can draw the inferences out of it. So this index number, you must have understood by now that we are using it for understanding the pattern. So it is basically a descriptive analysis where we are making use of this tool to draw the pattern, to understand the pattern, that what is the direction of data. Composition is available, what is the direction of data, and based on that we will be drawing inferences and making a prediction for the near future. There is another term called weighted composite price index. A weighted composite price index basically weights the price by quantities purchased prior to calculating totals for each time period. So we are basically, what we are doing, we are weighing the prices by quantities purchased prior to doing this calculation what we have done, and the weighted totals are basically used. So just like from simple to composite we were making use of composite totals, here we are going to use weighted composite values, weighted totals to compute the index in the same manner as we have been doing for unweighted totals for simple composite indexes. So the way of computing, the modus operandi of this calculation is not different. The only point is the way we are finding the numerator and denominator. In case of composite price index, we were taking composite data. In case of weighted composite price index, we are finding a weighted composite total for that. Now there is another term called descriptive analysis, in which we are going for having exponential smoothing. Exponential smoothing is something which is always a matter of great concern for all the learners, and they feel that, sir, what we do into this exponential smoothing, what is the modus operandi, what is the modality of doing so. So we have to first understand what is the type of weighted average we are going to calculate, and the type of weighted, it is a kind of weighted average, and here we remove rapid fluctuations in time series. So if there is some outlier in the data, we are going to remove that rapid fluctuation, and this is something about which I was talking about when I told you about this data cleaning, that it is the data which is the value which is less sensitive to short term changes in prices. That is something which we need to remove. Now I would like to give you an example here. During this global pandemic of COVID-19, what was happening? If you take up the data series, suppose if I have a time series data for last 10 years of any company, starting from 2013 to 2023, and if you ask me that, sir, we are drawing a trend line, but in the year 2019, the end of 2019, the entire 2020 and 2021, there is a very different kind of change in the data. The data is not uniform, and after that we got this correction. So had I been taking it like a machine, then I could have said that, see, you draw a trend line, you try to understand the pattern, you first draw a pattern, and on the basis of that pattern you draw inferences and give a conclusion, give a prediction. But since as a human being we are trying to draw the inferences out of the data available, we need to understand, and in this manner only the machine is being trained. When we talk about machine learning, the machine is being trained for this, that you have to find the outliers. What are those outliers? So it is not only me who is able to pinpoint that, even the machine can pinpoint that, see, this is the year in which there is some change in data, and this data is not giving the real picture. There is something wrong in this period, and if it is so, we need to report, we need to remove, and if it is not that, then of course it is going to be used while drawing inferences out of it. So suppose if I talk about the sales of a company, the revenue data of a company, of course in the year 2020 and 2021, if your entire business is closed, there was a complete lockdown. So how can your sale grow? How can your sale increase? So you have to remove that rapid fluctuation. So exponential smoothing is nothing but removing those outliers. So in short, if you ask me, I would say that you also understand that this is a problem and that problem need to be removed. Another example, I would like to give you another example to understand exponential smoothing. Suppose you are having your income. Your income and expenses, they have a normal pattern. So every month you get your salary, if I assume that you are a salaried employee, and you have certain sets of expenses. Now in certain months, suppose if you got some additional income over and above your routine income, there is a hike into your income in that specific month. Suppose you got promoted and you got some arrear of your salary, so that your account is being credited with that arrear, but every month you are not going to get promotion, every year you will not get the promotion, but your income has increased in that specific month, or if it is in a given month, or suppose if there is an increase in every month's salary, then of course that change is due to your promotion. So we need to understand that from where this value is coming. Likewise for expenses, if you are having a time series data of your expenses and you got some events at your place, suppose if there is you organize your daughter's marriage ceremony and you are spending huge amount on that, so your expense, if I try to have a pattern of your expenditures, then of course that pattern is not going to give me the real picture. Suppose I assume that in last 6 months your expenses have increased, and based on this I am going to increase your future expenses. I am going to make a prediction that in future also your expenses will be the same. Then of course will be committing a mistake, cause that expense were owing to, they were having a valid reason. They were owing to a reason, and reason was your daughter's marriage. Once the marriage is over, you are not going to spend that much of money on your household expenses or whatever expenses they are. So we have to remove those rapid fluctuations in time series if it is available, and we have to understand that the short-term changes in prices, for that we have to be less sensitive. But yes, if it is changing consistently, then of course we are going to take a note of it. And this exponential smoothing is basically permitting us to understand the overall trend. To identify the overall trend, we can find the aggregate trend of the data, whatever is happening, and it is used for forecasting future values. Exponential smoothing is very much applicable for forecasting future value, and once we do so, our predictions are very close to the real results or to the actual data. And then your prediction becomes the reality and the actual calculation. So exponential smoothing constant, they affects the smoothness of series, and suppose if I take the W close to 0, so more weight given to previous values of time series in order to make the series smoother. Suppose if W is close to, weight is close to 1, then more weight is given to current value of time series, and series looks similar to original, so it is more variable. So in case of smoother series, your weight is close to 0, whereas when your weight is close to 1, when W is close to 1, then more weight is given to current value of time, whereas in case of when W close to 0, we were giving more weight to the previous values of time, and series looks similar to original values. So how do we calculate the exponentially smooth series? We first select an exponential smoothing constant which is called as W, and it is always between 0 and 1. So numeric value we assign to that exponential smoothing constant. It is something which we select, and then remember that small values of W give less weight to the current value of the series and yield a smoother series. So since we wish to have a smoother series, we are doing so. And larger choices of W, they assign more weight to the current value of the series and yield a more variable series. So this is what we do. We have to assign W between 0 and 1, and if I say 0, small value, 0 is the smallest value, then of course we are giving less weight to the current value, and we are giving greater value to the previous values. Now when we talk about descriptive versus inferential analysis, in descriptive analysis we are having a picture of the behavior of time series, that is index number, exponential smoothing. But in this descriptive analysis there is no measurement of reliability. To what extent they are reliable, for that we have no specific calculation, and that is why we go for the inferential analysis, the second part of it. In descriptive analysis, increasingly we are using the time for this time series data analysis, we are using index number and exponential smoothing. Whereas for inferential analysis, my goal is to forecast the future values, and here we do have the measure of reliability. When I'll be telling you about those techniques, I shall tell you what are those measurements of reliability, what are the different tools into it, that I'll be explaining when we'll take up some numerical examples to understand what we do in case of inferential analysis. So there are different techniques. We have all set of tools to do this kind of analysis, and do remember, my dear learners, this is these are the advanced tools which are increasingly used by the corporate entities for their financial predictions. So if I talk about the time series components, it is basically, there is an additive time series model where we are adding all the changes. The first one is secular trend, which is describing the long term movements of your data. There can be a cyclical effect, there can be a cyclical change, which is describing the fluctuations about the secular trend attributes to business and economic conditions. So it's a cyclical. Once it is going upward, then later on it is going downwards. Just like trade cycles, you have ups and downs. So initially it is increasing, then later on there is a slight downfall, later on then there is a correction, and eventually it increases. So it can have a cyclical impact. There can also be a seasonal impact to your data, which is describing the fluctuations which occur during the specific time period. So this effect can be due to the seasonal changes also. And the last one is the residual effect, what remains after the other components have been removed. So once you remove all other components, what is left is known as residual effect. So while having a look at time series data, we should understand what are the different components of this time series data, and it is the nature of these impact is basically additive. That is why we call it additive time series model. We add all effects, starting from your cyclical impact, residual impact, whatever impact it is, we have to. So all four are supposed to be aggregated. Now the second step after understanding the pattern is exponential smoothing, where we go for forecasting, and we assume the trend and seasonal components are relatively insignificant. Seasonal component are basically ignored because it is very short-lived. For the time being, it is having a reflection in the data. As I have told you about the outliers previously, we need to understand that they have a relatively insignificant role for the purpose of prediction. So once we go for predicting, we have to understand that it is relatively insignificant if the change is seasonal. So exponentially smooth forecast is constant for all future values, and it is used for short-term forecast only. And for this we have for this entire discussion of index number, we have this is a source for that specific discussion. We have taken the formula and the other techniques from this specific book on statistics for business and economics by Benson and Senich, James McLeave. This is a book for analytics in finance. And when we talk about the asset returns in financial time series, we have to first understand that what is time series that we have discussed up till now. Now we'll talk about the financial time series, wherein we'll talk about asset returns, we'll talk about continuous compounding, we'll talk about portfolio return, dividend payment, excess return, and distribution properties of returns. So let us start with the asset returns. Most financial studies, if you look at, they involve returns instead of prices. So of assets, there are two reasons for using returns. Why do we use return? Why are we looking at the returns? The first one is, for average investor, if you look, a return of an asset is a complete and a scale-free summary of the investment opportunity. So there is no scale into it. Suppose I am acting as an average investor, I am investing into a company, and I know that my rate of return is, suppose I earn 10% return on my investment. So that 10% return is something which I have received. So it is basically a scale-free summary of my investment opportunity, and it is giving me a complete or holistic idea that out of my total investment, I have earned 10%. So we don't look at the figures, we are looking at the returns. What is my ROI or what is my ROE? If I talk about return on equity, if my investment is in terms of equity, I have to look that what is my return on the equity investment which I have made. And the second one is the return series are easier to handle than price series, because the first one have more attractive properties. So return series, if you have 10%, 11%, 12%, 15%, it is quite easy for you to draw inferences that, see, this is the way my profit is increasing, my ROI is increasing. Just like suppose if I take example of NPS subscribers, we are looking at our under national pension system, we are looking at our IRR, what is internal rate of return into this investment. So we are finding the IRR for that specific investment which we have made, and that rate is comparable. So this is the reason why we are using asset return into the financial financial series of data, and it is being preferred over the other values, that is price series. We basically always try to have the return series. We try to find the data in terms of returns in relation to the price series. We don't give significance to price series because it is always easy to handle the data which is available in return series. Now we can have different types of return. One period simple return. Suppose if you are holding the asset for one period for a given date, from the date t minus 1 to date t would result in the simple gross return. You can have a one period simple return calculation. And suppose if you are dealing with multiple period, you can have multi-period simple return. You are holding the asset for say given if I indicate period by k, between dates t minus k, and t gives the k periods k minus period simple gross return. So we can have multi-period simple return. We can have single period simple return. We can find that rate of return on our investment. Nowadays we talk about continuous compounding. You all must have heard the news of getting interest on daily balances. There was a guideline by RBI that now banks will give you interest, banks will provide you interest on the daily balances of your savings bank account. So whatever value you have, whatever balance you have in your savings bank account on daily basis, because in case of term deposit it is very much clear. You are having the data, you are having the investment, and at the time of making investment, the banker is giving you the maturity value that you are investing it at this rate for this period of time, and at the time of maturity this will be your value. So maturity value is known to us, simple compounding is done, and they are giving us the value that on the basis of the investment at a given date for a given time period, this is your maturity value. Whereas in case of savings bank account, it is very difficult for even bank to tell you that what will be your what is the total amount of your interest unless they do the calculation. So I cannot tell you well in advance that today I am telling you that for this entire month you will be gaining this much of interest, because it depends what is your daily balance. What if tomorrow you withdraw money from your bank account? So for that only bankers are having continuous compounding. I'll show you the way it is being calculated, and it is nothing but your financial time series. You are having daily balances, so the date wise value, the balance of your account becomes your time series data, your financial series of data. So I suppose if I assume that the interest rate of a bank deposit is 10% per annum and the initial deposit is ₹1. So 1 rupee you have deposited, and if the bank is paying interest once a year, then of course the net value of deposit becomes 1.10 after 1 year. That is something which I told you regarding time series, regarding time deposit when you are depositing it for the entire month. But if the bank pays interest semi-annually, which means twice in a year, so you have to divide the rate by 2, because it is being compounded twice, so 10% by 2, so effective rate is 5%. And in general what happens if the bank pays interest on interest m times in a year? Suppose I say bank is paying interest 365 times in a year, every day banker is paying interest, then of course the interest rate for each payment is 10% divided by m. M is nothing but number of times a banker is going to do the compounding, or you can say banker is going to calculate the interest on your deposit. So this is very much useful tool when we go for having continuous compounding. Suppose if I take example of a customer who is having daily balance of ₹3 lakh in his savings bank account or her savings bank account, and the rate of interest on the savings account is 4% per annum. So we can compute the interest. interest on a monthly basis. Suppose if I calculate the interest on daily balances for 1 month. So daily balance I'll take up, I'll multiply it by number of days into rate of interest divided by number of days in a year, right? So if I take 3 lakh rupees, 3 lakh rupees is being used for 30 days because I have to compute the interest for 30 days, and rate of interest is 4%, and we have total number of days in a year is 365. So I would say that this customer is going to have a total interest of rupees 986 per month. So in a month, this investor who is maintaining a daily balance of 3 lakh rupees in his or her savings bank account is going to have the interest of 986 rupees per month if they are computing the interest on daily balances. So it is nothing but your continuous compounding. It is being calculated. What if you wish to know the calculation for 1 day? Very simple it is. In the same formula, replace 30 days by 1 day. 3 lakh into 1 day into 4 by 100. 4 by 100 is your rate of interest. I have assumed that 4% is the rate of interest in the savings bank account. It is only an hypothetical example. Divided by 365, and if you ask me, I would say 32 rupees and 87 paisa roughly per day as interest the customer is going to have. So in this way, my dear learners, we can have this kind of calculation of continuous compounding, and it is very much useful. Now you must be thinking that we are talking about financial series of data, and this compounding is done by the bankers in terms of their interest calculation on savings bank account. So this is the way, my dear learners, we are doing this compounding calculation. When daily balance was 3 lakh rupees, number of days was 30, rate of interest was 4%. I told you how to calculate. So whatever is happening around us, it is basically, and if it is related to finance, if it relates to finance, it is the financial series of data. We would say financial time series it is, and you can do the calculation, you can find the pattern and draw the inferences out of it for better prediction. Right. Now there are other key concepts also which I'll be telling you in due course of our discussion. We'll talk about portfolio return, we'll talk about dividend payment, how do we decide, how do we calculate excess return, distribution properties of return. This is very important aspect or concept under the head of financial time series, where we'll discuss about distribution properties of return. So these are the points which I'll be discussing in the next lecture of mine. In today's lecture, I tried to tell you what we do in case of financial time series data, how do we draw the patterns, how do we describe or understand the pattern and draw the inferences for better prediction on the basis of given data. So we can make use of the formula, we can make use of the graphical presentation for better prediction. So with this, I tried to explain you the basics of financial time series, financial series of data, along with the help of the basic statistical tools like index number and different variants of it, just to provide you a better understanding of this time series and financial time series. So do remember, my dear learners, when we talk about the financial time series, it is no different, the tools are no different from the basic time series. The only thing is that the data belongs to the financial segment, the finance segment. It may belong to money market, it may belong to any segment or any aspect of business. I hope you must have understood and enjoyed today's lecture of mine. Thank you so much.